Hi, folks. Dan Bird here with the daily scan for February 12th, Wednesday, CPI day, inflation day. The market seemed to not care too much about higher inflation. It did tick up to 3%, just as I suggested it might yesterday in yesterday's video. For those that want to watch that, it was at minute 27 when I started talking about CPI, and I said that it very likely could go to 3%, and that's exactly what happened. After a big sell-off in the morning, the market bounced right back, not quite back to the top, but came right back. We're going to look at that in a minute. So I'm not a financial advisor, and this is for educational purposes only. You need to understand your own trading style and make your own trading decisions, of course. If we look at the market bias chart, it too basically did nothing today, sitting right exactly where it was. Now, there were some bullish and bearish signals, but they pretty much cancel each other out today. So nearly as many bull as bear. The one notable one is on the NASDAQ composite. It got a medium-term bearish signal today right here. So even though it sold off, it tried to come back, it still crossed over the line. It will probably will get a short-term bearish signal too tomorrow, pretty much no matter what happens. But you can kind of see right now, for those that I'm going to do a session, I think, on a Tuesday about trend line trading and do nothing but trend lines. So stay tuned for that. But if we look at, you can kind of imagine these, I think. So there's kind of a trend right there, and there's one right here, forming a symmetrical triangle. And normally once that breaks out, and it doesn't indicate which direction it will break, but once it does break, it usually moves quite a bit. So if it goes to the upside, it could take out the highs. If it goes to the downside, then it will take out these lows right here and probably head back to the 50-day. So we'll see. We'll see what happens. That's the NASDAQ. It's very similar on the other charts as well. So let's take a look at the S&P. I'm going to do something here in a minute with everyone. So there's that symmetrical triangle for the S&P. I actually drew it yesterday, so before today's candle it was even drawn yet. And 50 is the low, 6,100 is the high. We're still right in the middle of that range. Today didn't really do much to change anything. It's still sitting right above the 21-day moving average. It's still inside of that symmetrical triangle. So we'll see which direction it breaks out. I did do a technical Tuesday on patterns, chart patterns, and one of them was triangles. So if you want to take a look at that, you can go to the video that I did on that a while ago. All right, we'll look at Bitcoin, of course, just see what it's doing. Bitcoin had a little bit of a rally today. It actually got a medium-term down signal as well. So down here, you can see it also has a medium-term down signal. We got a short-term signal yesterday, and today got a medium-term signal. So it overall, the configuration is bearish right now for Bitcoin, as it is for everything else. But the market really isn't doing anything. It's just sitting there waiting for something to happen, basically. All right, let's take a look at the dashboard real quick. So you can see red NASDAQ had a little bit of green. The VIX actually went down slightly. Bonds, 20-year bonds went down. 10-year went up quite a bit, actually. There's the 10-year right from the beginning, went up quite a bit today. Commodities, and I covered these yesterday, and the reason why I thought it would go to 3% is because commodities were screaming higher. They're pulling back right now, which is interesting. There's oil pull back, there's gasoline pull back. So all the commodities, interestingly, all pull back. Gold and silver are still doing well, however, and crypto, of course. There's Bitcoin and Ethereum. Ethereum looks like it actually had a fairly good day, up almost 6% on Ethereum. All right, look at the rest of the market. Communication services and discretionary, so two of the aggressive sectors on the top for today. This is just today's sectors. And staples in the number 3. So we've got aggressive and defensive all at the top of the list. They didn't move much. So the bottom, actually, technology is right kind of in the middle. The bottom is energy and real estate. Down here we have the industry groups, and I'll show you something that I just added. So automobiles is number 3. That is in the discretionary sector. Travel and tourism, gold mining, U.S. mining index. So that's gold. Gambling right there. Gambling's moving higher. So if we look at this particular industry group, it's in the discretionary. So over on the website, on the charts page, this is for subscribers, of course. On the charts page, we can look at the discretionary sector right here, and we can go down and find gambling. So if we look at the chart for gambling, we can see that it's hit a double top right there, pulled back, and now it's above the 50-day moving average and trying to make a comeback. But the thing I just added is now this little square next to all of these industry groups will show you the stocks that are in each group. So for gambling, if I want to see which stocks are in that, since gambling was at the top of the top 10 list, these are the ones in the list. So you can see DraftKings right there, up almost 5% today. So this gives you a sense for which industry groups are performing, and then you can find the stocks that are performing. This is listed for just today. I can also look at it for the week, and that shows me DraftKings is up there for the week, 7.5% for DraftKings. So looks like it definitely is making a comeback. So that's one way you can figure out, not just to see which industry groups are outperforming, but how to go find the stocks in those groups. If I wanted to look at automobiles, for instance, which is also in discretionary, I go back here under discretionary, there's automobiles. They were in the bottom 10 last week, but now they're moving up. So here's the top ones, up 22% for Zoom Car. This is Chinese. There's a couple of, actually there's quite a few electric vehicles, EVs, in the top of the list right here. That's interesting as well. Tesla is right here. Tesla's been having a hard time, but actually ticked up slightly today. So that's one way you can find the stocks, not just know which industry groups. When I cover this at the end of the day and I show you the industry groups, now you know how to find the stocks that are outperforming. If we look over here at the top 10 list, Upstart, looks like they reported had a great day today. It was up 31% for Upstart. Here's a quantum computing name, just beginning to, looks like it's starting to perk up. This is a software company that I've been talking about lately, Gorilla. This one here, ARQT, actually had a short squeeze alert today. So this one has at least more than 20% of its float short. So that one has a short squeeze alert today. And then if we look at the bottom, look at this one here, Marvell is at the bottom. Maxell, MaxLinear, TravelZoo at the bottom, and the next level down, DXCM is reversing. Eris pulled back a little bit, but not much. It's still on our list. Roblox looks like it missed earnings. Affirm had a great move up and pulled back slightly, but not by much. All right, so the last thing I want to do today is go over here and take a look. Well, let's look at, because I prepared this, the relative rotation graph. So technology is improving, an improving quadrant. Here's XLC is the communication sector. There's real estate, utilities, and staples. These are the 3 most defensive groups right there. So they are moving to the upper right into the leading quadrant. Financials, healthcare, materials, and industrials are starting to move to the lower side. Energy is the worst performer. And you can see discretionary actually made a U-turn and is now moving straight down into the lagging sector. So looks like mostly defensive. Looks like that rotation is moving to defensive. All right, for this last segment, I want to go through on the charts page. Down in the lower left, I have a daily routine section. I'm going to go through some of these daily routine charts just to get a sense for what the market's doing. I'm going to start with this market cycles chart. So there's the market cycles with two areas where we could see some support. Right now, you can see the sideways movement that I've called out as a potential distribution phase. And I made sure to say that this will be negated if it breaks through the top, which is at 6,100. And it will be confirmed if it breaks through the bottom, which is at 5,850, but you can see it's just moving sideways right now. Now I have two Fibonacci levels in here, so you can see that the main one is right here. At if it breaks 5,850, then the next one is right here at the 200-day moving average. And so that you can now look at that every day to see what the status of that looks like. Trend analysis, I'm going to look at the S&P for all of these. S&P, what I'm looking at here is the medium-term trend. You see back here in 2022, when we got a red bar and the medium term went below zero. That has not happened yet. And we're still in that sideways channel right now. So that's what I'm looking for. Everything that I'm looking at, everything that I looked at today is indicating the market is not rolling over yet, that there's still potentially some life left. However, it's kind of a slow motion train wreck, if you will. It's giving us plenty of opportunity, plenty of warning signs, but it's not actually collapsing. And today was a perfect example. After a bad inflation report, the market went down in the beginning, but bounced right back again. So we'll look at the big picture here on the daily chart. You can see there's that sideways channel. So it is in a bearish wedge. I covered that on the patterns technical Tuesday I did a few weeks ago. Bearish wedges usually break to the downside, but it has not done that. Hasn't broken the wedge and hasn't broken the sideways channel yet. So sitting right there. Next, let's look at the Keltner charts. Tells us where the extremes are. It is right in the middle, literally right at the mean. So this green area is one average true range. So the distance that the S&P goes in one day, usually. The blue area is 2 times the average one-day range. And the red area is 3 times the average one-day range. And you can see when it gets up into the 3x area is usually where it reverses and comes back to the mean. And if it drops through the mean, it goes down to the bottom 3x area and then starts moving back. It is literally right in the middle, and it's been in the middle for quite a while, for a couple of weeks, at least 2.5 weeks now. So again, indecision. The one negative is that the ADX line, the red line, is moving up above 0, so, or above 25, I should say. So it is indicating that the direction might be down, but it is not confirming that that's the case. So that's the Keltner. So if we look at the 10-minute, you'll clearly see what happened in the morning. We had this big sell-off in the morning and then came almost all the way back to the open, or the close from yesterday, I should say. Not quite, though. And then it pulled back, tried to make a run again, actually didn't get as high. So that is a lower low. Now this is a 10-minute chart, so it's very short term. So there's a lower low. There's a low right there. It has not made, a lower high, lower high. There's a low. It has not made a lower low yet, but that's what we would be looking for. And this one is for mostly the aggressive sectors. The only one that outperformed for the week is communication services. And if I look at the defensive sectors, you can see that staples, utilities, I don't have real estate on here, but real estate outperformed as well. But the defensive sectors are doing better. So that is an implication, implying that perhaps the break will be to the downside. Let's look at XLY versus XLP. This is discretionary versus staples. You can see just in the last week or so, it is clearly heading south. So that's not what you want to see. That means rotation is going on out of discretionary and into staples. You can sort of see it right here as well. So you can see it, the rotation actually started into staples in the middle of January, and it didn't really start out of discretionary until the last couple of days of January. But now looks like it's moving that way in earnest. So that's rotation. We'll also take a look at breadth. So breadth analysis. This shows us, again, there's that sideways channel. So here's the NDX. This is the NASDAQ 100 advanced decline line, still looking pretty good. New York Stock Exchange is rolling over. Large cap is okay, but rolling over. Mid cap is rolling over even more, and small cap is rolling over the most. So even though the large cap tech stocks are hanging in there, everything else is implying that it might be starting to roll over, but it's not significant. If we look at intermarket relationships, there's the NASDAQ versus the S&P, clearly down, growth versus value. There's the rotation out of growth. Discretionary and staples I talked about already, mid cap versus the S&P, rotation out of mid caps, rotation out of small caps. So the rotation appears to be, as we're in the sideways channel, again, to me, it looks like a slow motion train wreck, and something is going to happen. I thought it might be the CPI report because it came in higher than expected, but it didn't really seem to have much effect. So the market just does not want to go down. We'll look at the McClellan oscillators. This is a moving average of advanced decline, and you can see today it's sitting right on zero. So there are an equal number of advancers as there are decliners. The market kind of went sideways, down slightly maybe, and the bullish percent index is still above 50. So it's not giving warning signals yet, but it's starting to roll over. But this one right here is giving you a sense that it might be heading to the downside. All right, sentiment. Let's look at the VIX. VIX actually is doing really well. So the VIX is still below 17 and tried to make a run to 17 early in the morning, right after that inflation report, and then pull way back. So the VIX is not really telling us much. It's actually still in the bullish configuration. 5-day put call ratio. When it gets down here, that means there are lots of calls. It means there are a lot of people that are bullish. And usually that's overly bullish when it gets down into this area. That's the time when usually you see a top form. But the VIX is still way below 17. The VIX is starting to move up slightly, but the 12-month rate of change is actually moving down. So the VIX is not giving us any signal that something bad is about to happen. Let's look at risk on, risk off. This is kind of the same thing. This shows you junk bonds versus the 20-year treasuries. It's still moving higher. Pull back slightly just in the last couple of days, but definitely still moving higher. Investment grade versus the 7 to 10-year bonds, still moving higher. High yield corporate bonds versus 3 to 7 treasury bonds, still moving higher. This shows you if Wall Street is risk on or risk off. If they're willing to go into junk bonds and lower quality bonds, they're still high quality bonds, but lower than a treasury bond, for instance, then it's still risk on. Russell 1000 growth versus value. This is a weekly chart. It's still in positive territory, even though it's starting to pull back. And discretionary versus staples, again, also starting to pull back. Did not quite make it back to the high over here. But nothing here is indicating that we're in big trouble yet either. Let's take a look at the high-low chart for the S&P. So these are the number of new highs on the New York Stock Exchange. So you can see this has just gone negative right now. So there are more new lows than there are new highs, even as the market is hitting all new highs, or at least hitting highs, not all new highs. But more, even better is if we look at the high-low chart. And this one now shows you there's the new highs minus new lows that I just showed you right there. But down here are the S&P large cap new highs versus large cap new lows. You can clearly see that new highs are declining and new lows are increasing. And this is the AAII. This is the Investment Advisors bullish sentiment. Their bullishness is declining and the bearishness is increasing. In fact, it's increasing significantly. It's below the 40 line now. So that's an indication that things are becoming much, much more bearish even as the market goes sideways. So that is on the negative side of the ledger. This is the National Association of Advisors. Whenever it gets up here to a peak, that means they're overly bullish. They did get overly bullish right here at this peak. Then the market's just been going sideways, and they're starting to become less bullish. But still, it's above the 50 line, so people are still bullish. So there are when there's lots of bulls out there, that usually is a counter indicator. All right, let's look at the 50 and 200 day moving averages. This is always an interesting one because, again, you can see that sideways channel that the S&P is in. There's the put-call ratio. There's the 0.52 line right there. Down here are the percentage of stocks above their 20-day moving average. And you can see ever since the middle of January, the number of stocks, the percentage of stocks above their 20-day is declining. Right now it's below 50%. So that's usually what starts to break first. Next is the S&P percent above the 50-day, and that's sitting right at 50%. It's actually at 48.6%. And the number above their percent above the 200-day right now is at 58%. So all of these are starting to decline. The 20-day is heading lower the fastest. So something to keep an eye on. If we look at that on the NASDAQ right here, since the NASDAQ 100 has 100 stocks, you can tell exactly how many stocks there are. So in this case, it's a little better. For the 20-day, 62 are above the 20-day. 50-day, 62 also above the 50-day. And for the 200-day, also 62. Interesting. All three of them, there are 62 stocks above the 20, 50, and 200-day moving average right now. If the market starts to really crash and these get down really low, I will show you how to find those stocks. So if this gets down to like 20%, which is this number right here, this green line, when this gets down to 20%, I'll show you how to actually find the stocks that are above that. Those are the ones that are the strongest and the ones that likely will recover the first if we get a big sell-off. Bullish percent index for the S&P right there. You can see it's starting to roll over as well. So relative strength is declining. The bullish percent for the S&P is rolling over, and even as the S&P goes sideways. So all of that gives you a mixed picture. There are some things that look like things are still strong or at least hanging in there, not ready really to crash yet. And I don't think it's really going to crash necessarily. I think we might get a pullback, 5 to 10%, but that would be healthy if that happened. But some of these aren't showing any signs of that happening. Other ones are indicating that we might be in the early stages of something like that happening. So we'll keep an eye on it. That's the daily routine. Anyone that's a subscriber can walk through those just like I did. Doesn't take very long. It only took a few minutes to actually look at them all. So really gives you a sense for where the market is right now. By the way, actually, that's not what I wanted. I wanted the monthly index charts, monthly momentum. Still looks like this. I haven't updated this. This is from Friday, but it still looks like this today. If this February bar turns dark blue, then I will update this as soon as that happens. But anyone that's a subscriber that wants to see what the status of that is, they can just come to the charts page, and it's right at the top, index charts right here. All right, that's it for today. Good luck, everyone. Hopefully you will stay safe, and we'll see how the market does the rest of the week. Earnings are starting to wind down. Right on the homepage, you can see what earnings are coming up. If we look at the NASDAQ 100, we can see today's upcoming earnings, rather. This actually was for today. All of these reported. Datadog reports tomorrow. Airbnb reports tomorrow. Palo Alto Networks tomorrow. So there's still some big ones that are still coming in. Booking.com. So there's still lots of companies still coming in and reporting. There's Broadcom down here. Costco reports on the 6th of March. So we still have a couple of weeks of earnings still left. And once earnings ends, then there's not going to be any catalyst to keep the market up. So if the market continues going sideways for the next few weeks into the end of February, then after earnings is done, there really won't be a catalyst to keep things going. And as I showed you before, we can see what the market looks like, or what the historical trend looks like. We are right here now. So you are on Wednesday. You can see that historically in February, it's very choppy until we get to right after President's Day. And then there's usually a downtrend. So the end of February is usually more bearish than the beginning of February. So keep that in mind, because that might be what tips things over once we get there. But it looks to me like we might just still continue to go sideways as long as earnings come in okay. All right, thanks for watching. Please like and subscribe. And if you would like to get a copy of the newsletter, it's in this little box right here, breakpointtrading.net. So the free newsletter you can get right there. You don't need anything. You don't need a subscription. You don't need to put an email in, none of that. So that's where it is. Thanks for watching, everyone. Have a great Wednesday, and I'll talk to you tomorrow. Take care.